Well, this week has been quite eventful, with markets reacting to the U.S. Fed rate cut, weak economic data, and the U.S. President Donald Trump announcing plans to impose a 10% tariff on the remaining $300 billion worth of Chinese imports. Following which, the global equity markets tumbled. Beijing has pledged to respond if the U.S. insists on adding extra tariffs to the remainder of Chinese imports. The global equities, currencies, and commodities reacted sharply to these developments. Hello and welcome to Commodity Champions, your weekly dose of what's brewing in the commodity space. I'm Manisha Gupta, and today we look at the precious metals and the jewelry sector. Platinum and silver are set for a first weekly decline in 4 weeks, while the gold prices have started the month on a firm note. Joining me now to discuss the movement in gold and how can you successfully invest in it is Anand Rathi Wealth's Firoze Azeez. Firoze, hi, welcome to the show. What is your sense, first of all, with the way the gold is up by, it's up nearly 14% this year, while the other asset classes have underperformed given the domestic and the global scenario. We have the gold prices, as I said, up 14%. When you look at Nifty, that's just about a percentage point higher in this year. And then you have the Sensex, which is up 3%. What is the near-term investment scenario now looking to you?
See, of course, I think from a short-term perspective, I completely agree with you, Manisha. I think gold has done justice to investor money, unlike the rest of the three asset classes, which is real estate, equity, and debt. So that's definitely something we should definitely consider as a part of the portfolio, especially for a person who has objectives in the dollar terms. If you have expenditure in dollar terms, which happens over life as life progresses. So from a personal finance standpoint, it has merit. Provided there are objectives which you wish to meet using dollar, point one. Point two, now substantiating my long-term gold negative stance is because gold as an asset in the long run turns into a currency. It stores value, and for the rainy day like what we see today. So point two I'm making is, from a long-term standpoint, expecting an asset like gold to deliver returns as equity and real estate itself is unfair, because gold is a protection asset. That's point two. Point three, because gold has this inherent capability of buying dollars for a retail client, which is not the case in any other asset classes, because there are only two things a retail person can do to buy dollars for himself or herself: is buy a global fund on the mutual fund equity side, or buy themselves gold from a gold jeweler, and that you in effect have bought dollars. So these are the three reasons why there are merits and demerits, but I see people expecting 12, 13, 14% return on a long-term basis. They have to taper their expectations, because gold should deliver 8, 9, and not more than that. It's not fair to assume that it should give you more than that. I would be happy with that kind of return, which it has over the last 3 years.
Well, yes. But, Firoze, India buys a lot of physical gold when it comes to, jewelry and bars and coins, etc. But when it comes to investment, gold usually does not find place in portfolios very often. How much and in what form should one now hold gold?
See, having physical gold, I think, is an obsolete idea. If as a viewer, if you have physical gold in the form of bars and coins, it's long gone. But unfortunately, people still continue to hold it. Why is it? Why am I making such a large claim that it's an obsolete investment idea? Is because there is a replacement competing instrument which beats this hands down. What is that? That's a sovereign gold bond. Gives you an interest on a recurring basis, so makes it a monetizable asset over a period of time. And the second part it does is it gives you zero capital gain if held till maturity, and zero capital gain is a thing of the past, especially on the equity side in this kind of tax regime. So these two big advantages makes gold coins and bars for me and throws it out of the window forever unless the rules on the bonds change. Second point is, what's the extent, Manisha? To my mind, you should have 10 to 15% of your money in gold, but make sure that you have objectives and aspirations which consume it. For a high net worth individual, there are other mechanisms where they use liberalized remittance schemes to buy dollars. For a retail investor, gold becomes a very, very good proxy for dollar expenditure. So 15 to 20% can get there in the early stages of your life, because you will want to buy yourself experiences with travel and child's education, and that's the percentage I would ascribe to the gold portion of a personal finance portfolio.
Okay, so Firoze, coming in on the point, if the gold is a good long-term investment rather, as we are in a difficult global scenario right now, and it does look like that we are in this scenario for a slightly longer extended time. So when you advocate gold for a shorter term, but not so much for a longer term, what exactly is the period that you're looking for?
Correct, it does. Certainly it does. Why? Because all assets have to be, you have to allocate the same 100 rupee to different assets. Could be deposits, could be equity. So your method of allocation or your science behind this allocation has to be relative prices between these assets. So gold actually has inherent two assets. One is the dollar and the other is the gold dollar price. Both of them are not at their peaks. So you are getting it cheaper. And this coupled with debt having a crisis, equity going through some degree of rationalization, and real estate going through a structural change in terms of regulation, so relative valuation, it is better poised, point one. Point two is that both these intrinsic attributes of gold are not at the peak. So I would say from a investment standpoint, gold definitely makes sense. Like Manisha, there is another series of gold bonds coming. Would I bet some money of my debt replacement? There for sure, but I'll have fair expectations and not have extrapolations of just the last 1 year return to predict the next 6-7 years of the gold bond maturity. That's the word of caution I would give.
All right, Firoze, that word of caution is very well taken. But since you've actually completely rejected the physical gold and you've actually advocating the paper gold or the monetized part of it, so when it comes to gold funds, gold ETFs and sovereign gold bonds, as you've been talking about, what then is a better place to be in?
See, if you are investing a lump sum money, then it has to be gold bond. Because you don't, that's an intermittent asset. It's not a continuous asset. If you're doing a systematic investment plan, then a gold fund would do justice. So I think these are the two assets, gold fund and a gold bond for lump sum investments, for recurring commitments of your recurring inflows of salaries or any professional income you receive. So these will be the two asset classes for different categories of money already earned and expected to be earned.
All right, Firoze, thank you so much for joining us and telling our viewers and views on that gold. And that is what Firoze really seems to be saying, that you should be investing really into sovereign gold bond. And if it is recurring, then perhaps it is going to be about gold ETFs and gold funds going forward. But let's get in more depth on the same theme. And joining us now is Kotak Mutual Fund's Laxmi Iyer. Laxmi, hi, thank you so much for joining us. This week and the last couple of months, for that matter, really have been about gold and the kind of performance that we've seen come in for that one. What is your expectation? Do you see the investment in gold picking up from here on? Because when you look at the international markets, gold is trading at a premium. When you look at the gold prices in the Indian markets, it's actually ruling at a discount, actually trying to lure more investors here. What is your sense? Are more people now going that way?
No, I don't think so. That trend will change anytime soon because, if you see the unknown numbers in gold, today when somebody is allocating $100 of their investments into various asset classes, it's by default assumed that gold is anyways there in the form of jewelry or biscuits or any physical format. So I think, if you include for that, gold will still be a reasonable chunk of their intended asset allocation. So I don't think anything is going to materially change. In fact, I would say it's a big sigh of relief for them. The 7-year itch has been broken and finally you're seeing some returns accrue in gold to them.
Lakshmi, you've been following gold and gold funds for a very long time. What is your sense? Have the gold prices or gold gains peaked as of now? Most of the people really seem to be believing that we are on a much, stronger cycle right now for this year, for the next year as well. Is that a bit of an impetus to start investing here?
See, 2-3 things. If you see, the world central bankers are buying gold, so there is a UK Brexit related issue. So you're seeing China buy gold because of the trade war issue. You see Russia buying gold. Very recently, we saw Poland buying gold. So, it is a central bank led buying because world over interest rates are tending to negative, more than $13-14 trillion going into negative territory. Retail buying is not that very dramatic, which is reflective if you see in India. The ETFs have not added any assets in the last 1 year. despite the fact that gold in rupee terms has given almost 18% plus returns. So it remains to be seen how much of interest you can entice, especially seeing this kind of a rally. I would have my very serious doubts. The other thing is there is, the US interest rates, it's not going to be a protracted one-way down cycle. That is what we understood from the FOMC meeting a couple of days back. So that leads you to the fact that yes, gold returns have been high. Is it going to sustain? Probably yes, but is it going to be a one-way street upward in terms of prices? Highly unlikely.
All right. But, given the fact that the gold funds have outperformed other asset classes, is it still a good idea to hold positions in gold? Because when you look at the mutual funds, gold funds, we have seen nearly 16% of a surge in returns when you look at the last year, which ended 30th of July.
No, definitely. See, if you look at gold funds and gold ETFs put together, the total amount is not very sizable chunk. The total gold ETFs assets under management is less than 5,000 crores, and the gold fund of funds put together is not even 7,000 crores. So, given that allocation, I think should remain, because gold is your last man standing, in the entire financial portfolio. So that amount should continue as long as you're holding anywhere in the ballpark region of 5 to 15% of a 100 rupee financial asset allocation. I think you're absolutely fine, and it's very incidental that you're getting these returns in gold, and it's making up for some lost opportunities in the past few years. So that portion can remain untouched. But if you don't have any gold in your portfolio, and this is what I keep telling a lot of investors, don't really bother about timing in at what level you should enter in. Just do a staggered investment and just keep it, because your financial portfolio will make enough money for you.
All right. So, but when you say 5 to 10 to 15% of your portfolio should be gold, is it too small? Because, the way a lot of mutual funds, a lot of fund guys talk about gold, they treat gold more as an insurance rather than an investment. I mean, you pretty much said that you're same.
I completely agree with that. We buy an insurance on our life, not because we know we're going to pop off tomorrow. It's because if something happens to us, obviously we have that kitty available. Ditto with gold. It's like a term cover. So if, the world actually gets into a turmoil, we're seeing trade war, we're seeing geopolitical, we're seeing so many such things around us across the world. So if something were to happen to your financial portfolio, gold will clearly stand tall. And the endorsement of the fact is that central bankers across the world are actually rushing to buy gold. So I think there could be some more legs to the rally, but let the investor not be sitting in a myth that just because he has seen such stupendous returns, it is going to continue leap by leap, day on day. That's not likely to happen.
Well, true that, and that's not the case for any of the asset classes for that matter. Why just gold? But just before we let you go, Laxmi, what is your sense on the choice of gold investment? Because that is exactly the question I was asking Firoze as well. Physical is clearly something that you guys are not advocating, but when it comes to paper gold, when it comes to funds or ETFs, what is your favorite choice there?
So gold ETFs, of course, it's paper gold. If you want liquidity, it's available on the exchange. But if you're okay to forego some bit of liquidity and that similar kind of ease in transaction, I think sovereign gold bonds, which give you at least a 2.5% coupon, which is over and above the gold returns. And the recent tranche also offers a discount of $50 on a gram. So I think a combination of these either or could be a fantastic bet. As I said, be aware of what kind of liquidity constraints you are in. If you have clear liquidity as your mindset and you want to participate in gold, it's clearly the gold ETF or the gold fund of fund way to go. But for every other investor, I think sovereign gold bonds do make a lot of sense.
So you and Firoze really seem to be pushing a lot on sovereign gold bonds, and the government, of course, it is their product, and it's an amazing product, as you point out, 2.5% of gains per annum, and if you hold it till maturity, there's no tax to be paid onto that as well. But even with so many positives, why would you say that it hasn't really picked up so much? Is it because it's not pushed enough? Is it because there is not enough awareness? What issues do you really see with that?
See, the clear reason for that is the traditional mindset, right? My mother still wants to buy a physical gold. How much ever I convince her to buy an ETF or a sovereign gold bond, I might be a different genre, and our generations below will be a very different breed altogether. Today, we still are actually fighting with China in terms of who will consume more gold on a tonnage basis. So I think it's also got to do the mindset. The other thing is, because the gold prices are rising, there is a general tendency to push the demand to a future date, unless it's for a wedding or a function, etc. So I think the elasticity also plays its own role because of the price point increase. So I think all of those are responsible for the tepid demand for gold through sovereign bonds or ETF.
All right, Laxmi, we'll let you go at that. Thank you so much for joining us. So that is exactly what our guests are telling us, that this is a good time to start buying in gold. Do not time it really, but having gold in your portfolio, even if it is by 5 to 15%, is a good idea as nowhere time. But with that, we'll go take a short break on the show. When we come back, we will talk about the jewelry sector and the ongoing trends in the market. Stay tuned.